In Chapter 2, we'll be looking at tax compliance, the IRS, and tax authorities. We'll be specifically identifying the filing requirements for income tax returns and what we call the statute of limitations for assessment. Then we'll outline the IRS audit process, how returns are selected, the different types of audit, and what happens after the audit. Evaluate the relative weights of the various tax law sources. Describe the legislative process as it pertains to taxation, how tax law is created. Perform the basic steps in tax research and evaluate various tax law sources when faced with ambiguous statutes or laws. Describe tax professional responsibility in providing tax advice. And identify taxpayer and tax professional penalties. So let's get started. Tax filing requirements. All corporations must file regardless of their taxable income. Estates and trusts must file tax returns if their gross income exceeds $600. And individuals, it all depends on the taxpayer's filing status, age, and gross income. Since we're focused on individuals for this semester, that's where we'll be focused on. So let's take a look at some of the exhibits in Chapter 2. So what this is saying is if this is your filing status and your gross income is at or below this dollar amount, you do not have to file a tax return because you will have no tax liability. So if you're single, it's $12,000, which is what we call the standard deduction. That's an amount that's automatically deducted if you're single under certain circumstances. So if your income is $12,000 or less and you're considered single, you may not have to file a tax return. If you're 65 or older and single, 13,600 is your magical number, and we're going to show you how to determine standard deduction in the next chapter. Married filing a joint return. Now their standard deduction is $24,000. So anybody who's married filing a joint tax return, combined income, if it's less than their standard deduction, they don't have to file a tax return. And then this amount goes up if you're 65 or older on either spouse. If you're married filing a separate return, doesn't matter what your gross income is, you still got to file one. Now, if you're in the status of head of household, your gross income could be $18,000 or less, no filing of a tax return. If you're over 65, that increases to $19,600. And a surviving spouse, which is what we call a qualifying widow or widower status, which we'll explain to you in the next chapter how you determine that, they're also at that $24,000 threshold. So if your income is less than that amount and you're in that filing status, you do not have to file a tax return. Now, one thing I want to clarify here is just because you don't have a tax liability per se, you may still want to file a tax return if you had income taxes withheld or you paid any into the federal government. The federal government isn't going to look and go, oh, look, they're single and they made $10,000. They're not filing a tax return. Oh, but their employer withheld $300. We better send that back to them. No, you still have to file a tax return if you want to get a refund of any of your taxes. But if you had no taxes paid in on your behalf to or by yourself to the federal government, we're saying here you do not have to file a tax return. When are tax returns due? Well, when you're an individual, it's the 15th day of the 4th month following the end of your tax year. Most taxpayers are on a calendar year, so December 31st is the end of our tax year. So April 15th is the normal due date for a tax return. C corporations, generally it's the 15th day of the 4th month following the end of the tax year. Partnerships and S corporations, it's the 15th day of the third month following the end of tax year. So to differentiate between a C corporation and an S corporation, C corporations are more of your traditional corporation that cannot qualify for any other status. So they're corporations normally that are large, very large, and are traded on a stock exchange. They could be private as well, very large corporations that are private. But generally, these corporations file a tax return the corporation itself pays tax on the profits, and then when they distribute the profits as dividends, the individual who receives those dividends must also pay an income tax on the dividends. So the profits are taxed to the corporation when they earn them, and to the shareholder when they receive a dividend. S corporations are different. Here's an example. XYZ has a tax year which ends on August 31st. Their tax return will be due December 15th, the fourth month, 15th day from the end of their tax year. Assume they file an extension, well, then their tax return would be due by June 15th, the sixth month. Often tax returns are filed with incorrect amounts reported either in the taxpayer's favor or the government's favor. We're humans. Mistakes happen. If that happens, the time in which the taxpayer can file an Next. Here's an example. Bill and Mercedes filed their 2013 federal tax return on September 6, 2014, after receiving an automatic extension to file their return by October 15. When does the statute of limitations end for their 2013 tax return? Well, September 6th, 2017, 3 years from the later of the original due date or the actual filing date, whichever is later. The original due date is April 15th. The actual filing date is September 6th, 2014, so count 3 years out. So they have 3 years to either amend their tax return, or the IRS could look at their tax return and assess a tax deficiency. Now, when it comes to the IRS, and we keep saying IRS, and we should probably explain them a little more. Internal Revenue Service. So you might want to take a few notes on these. The Internal Revenue Service is an agency of the federal government. Their job is to police the tax code. They do not create tax law, and we'll be talking about how tax law is created in a few minutes. Tax law is created, and the IRS is given the authority to organize it so that it's more understandable to the average person. That we call that the Internal Revenue Code. Create tax forms so that it could be reported correctly and understandably by the average taxpayer. And then make sure that the tax law is properly being followed, and that's where they come into audits. So that is what they are given the authority to do. So really, they're not the bad guys, they're just the police. In general, a taxpayer's return is selected for audit because the IRS believes there's a problem. There's something wrong on the tax return. You're not following the tax law. Just like if you are suspected of speeding, you're going to get pulled over. The IRS uses computer programs to identify these potential items. It's called the Discriminant Function System, and it's based on scores. So it looks at your tax return, looks at items that could be misstated, the probability of the misstatement, and comes up with the score. Document perfection, it checks for math errors on your tax return. Information matching programs, it compares tax return data with other IRS information. For instance, and this is very important, if you or a taxpayer gets married and they change their name, they must change their name with the Social Security Administration because the IRS matches up Social Security numbers and last names. So if the new married person starts using their new name on their tax return and did not change their Social Security number or name at Social Security, then this is going to be flagged for audit. So what types of audits happen? Well, the IRS doesn't come busting down your door for every audit or make you Now, when there's an IRS exam, you can see from the very top box that it's our central location. The first thing you could do is 1A. You could agree with it and either pay a tax due or sometimes they owe you money. Isn't that nice? But when B could happen, and that's when you disagree with what they feel is the correct solution. You would have a 30-day letter, and in that you're going to request an appeal. The appeals conference would then be conducted. Appeals conference will then let you know what has come out of the next examination of it, and you would either agree with the appeals conference and either pay the tax due or disagree. And when you disagree, then you're in what's called a 90-day letter. If you agree with a 90-day letter, you pay the tax and you file a claim for refund with the IRS. If the IRS denies the refund claim, you would file suit in a U.S. District Court or U.S. Court of Federal Claims. With the 90-day letter that you do not want to pay tax, you petition a tax court. So we're going to be looking at the court system now, because just like the IRS polices the tax law, it's kind of like the police, police, without using the word again, policing laws about driving your car. If you're caught speeding, you don't go, normally, you don't say, yes, I was speeding, here's my fine, okay, have a good day, especially if you don't feel you were or you felt the officer was in the wrong. So that's how it works with an IRS audit. If you agree with it, okay, if you know, yep, I did that wrong, I'll pay it. But if you feel you did not do anything wrong, we're going to show you how you can prove those situations, then you will take it to court. Now, there's different courts. There's the U.S. tax court. You saw that if you don't want to pay the tax first from that 90-day letter, then you will take it to the U.S. tax court because they don't require you pay the tax up front. It's a national court that's tax experts, tax court. The U.S. District Court and the U.S. Court of Federal Claims, you pay the tax first. Now, the District Court is a local court. You could use a jury, and it's more general. People are not experts in tax. The U.S. Court of Federal Claims is a national court, again, generalist. You pay the tax first again. In this kind of court, you could appeal to the U.S. Circuit Court of Appeals for the Federal Circuit. So it all depends on where you want your lawsuit to go and if you want to pay the tax first or not. That will determine where you file your claim. So there it is, a flow chart of our judicial system. Now, there is what we call the U.S. Tax Court Small Claims. This This is a picture of the U.S. Circuit Courts of Appeals, the different districts, just to give you a flavor for what you're looking at. Now, when you are going to take a tax lawsuit to court because of disagreement with the IRS, you have to remember that the court system is looking at legal authority. So they want law. They want your evidence to be based in something that created the tax law. For instance, statutory services. They're right from the Internal Revenue Code. That's the law. Judicial sources. The courts made a decision. You need to find courts that support your position. Or administrative sources, more IRS pronouncements. So we call those primary authorities because if you can prove your position, why you did something on a tax return through any of these types of sources, and the more the better, you have a better chance of winning your lawsuit. Secondary authorities that can also be used but are unofficial tax authorities are what we call tax services and tax articles. Stands for the week of the ruling, and 001 is the ruling number. I hope I just didn't erase everything there. But if I did, I apologize. But we're just showing you how we cite primary authority and what it means. Please read through this. Get a feel for it. I know it's all brand new, but I would even keep a copy of this so when you get out in the world, you can use this, because you will. Here's some U.S. courts and how they are cited. It's usually the name of the taxpayer or the company, and it's usually versus commissioner, depending on who's bringing the lawsuit. The commissioner in this case will be the plaintiff. Kowalski is the defendant. So all depends. First name is the plaintiff, second is the defendant, and then you could read through how each of these are cited. Depending on the court will depend how it's cited, and they're put into different databases. Some secondary tax authorities. These are the ones where they don't hold the weight of primary. There are many tax research services. Just like lawyers have law libraries, accountants have tax libraries, and that's what these are. They're huge databases with information from primary authorities. So you're looking at Internal Revenue Code, court cases, regulations, revenue rulings, revenue procedures, all those things that were just on those last two slides, plus their own interpretations. So we have BNA Tax Management, CCH, Standard Federal Tax Reporter, RIA. Those are your three main companies that are putting out tax research services, tax libraries, databases for you to not only look for primary information, primary authority, but also look at what they feel on the secondary side. Daily tax reports, newsletters that are put out, Federal Tax Weekly Alert. There's law reviews, even because there is, it's tax law. Professional journals. So you can rely on these as secondary sources, but not as your primary source. You can help back up your position, but don't rely on them as your main source. You could use this book. So now they want to know, are the following primary or secondary? Well, the Internal Revenue Code is primary. That's made from the tax law. A tax article in USA Today, secondary. Article on Supreme Court. This is an article. This is secondary. A Supreme Court opinion, that's primary, but not an article on it. RIA Federal Tax Coordinator, that's one of those tax law services, that's secondary. And then a Treasury regulation is primary. That's right from the IRS. So it all depends on where it originates. Definitely. Statutory authorities. This U.S. Constitution is the 16th Amendment provides Congress the ability to tax income directly from whatever source derived without apportionment across the states. People say, oh, Taxes are not constitutional. Yes, they are. Tax treaties are also a primary authority, and this is agreement negotiated between countries that describe the tax treatment of entities subject to tax in both countries. If you're a citizen of the United States but work in another country, you must file a United States tax return, even though you didn't work here. So you may have to file a tax return in the country where you work and also the United States. And there's tax treaties between those countries so that those individuals will know how to handle their tax situation. All right. So let's go through the statutory authorities. We introduced you to them a little bit. We looked at some of the citations, how they're cited, but what are they? The Internal Revenue Code, as we said, is created by tax law. Let's talk about how tax law is actually how it originates and goes through all its different phases to the point of being a tax law and becoming part of the Internal Revenue Code. A proposed tax bill is created by a committee in the House of Representatives of Congress. The committee is called the House Ways and Means Committee. We already saw that. Remember, if they have their committee reports, so when they're creating a tax bill, they're going to have reports going on about all the discussions. You can use this as primary authority. It is then taken to the full House of Representatives to vote. If it's approved, then it goes to the U.S. Senate. The U.S. Senate then sends it to their Senate Finance Committee, and we also talked about them. The Senate Finance Committee reports, again, that's all of their notes and discussion while they are creating tax law. Now, the Senate committee will either say, we like this bill that the House of Representatives voted on and passed, or we're going to revise it a little. And if they revise it, and if they don't, the U.S. Senate votes on it. So whether they vote and they pass the same bill as the House of Representatives, if they do that, the bill then goes to the President. If they vote a revised bill, then there's a joint conference committee, and that's over on your right side. It's made up of members from both the House and the Senate, and they revise the two different bills, the ones from the House of Representatives and the one from the Senate, into one. The joint conference committee finishes their magic, sends the revised tax law to House of Representatives. They vote on it. If it passes, it goes to the U.S. Senate. If it passes there, it goes to the President. The President from there could either sign the act or veto the act. Well, it still doesn't end there. Just like any law, if Congress overrides the President, so there's a 2/3 majority vote in the Senate and the House, then they could override the veto of the President. If there isn't, the tax bill dies. So it's just like any other federal law, how it's created. The one thing to keep in mind is that they really won't be proposing Now, the judicial sources, again, the courts are tasked with the ultimate authority to interpret the Internal Revenue Code and settle disputes between the taxpayer and the IRS, the police. The IRS interprets the law one way, the taxpayer interprets it another way. Who's right? The courts will decide that. Supreme Court, the highest judicial authority, has the same authority level as the Internal Revenue Code. So if a decision is made at the Supreme Court level and you are using it to justify your tax position, it's just like Congress wrote the law. The Court of Appeals, 13 circuit courts, is the next level of judicial authority. The trial level courts, remember there's 3: U.S. District Court, U.S. Court of Federal Claims, and the U.S. Tax Court. All courts apply the judicial doctrine of stare decisis, which means that a court will rule consistently with its previous rulings and the rulings of higher courts with appellate jurisdictions. The tax court applies the Golson rule. So, what this is saying is, if you try to take something to court that's already been decided at a higher level court, they are going to use the previous ruling. They're not going to reinvent the wheel. Administrative sources. So we have the tax law, we have the court, now we have other items put out by the IRS that have primary tax authority. Regulations. The Treasury Department's official interpretation. Now this is from the Treasury Department. Sorry, this is from the Treasury Department. They're separate from the IRS. The Treasury Department. They're the ones collecting the money, the tax. This is their interpretation of the Internal Revenue Code. And then we said there's final, temporary, and proposed regulations. 3 different purposes. They interpret. There could be a procedural regulation, how the IRS should be conducting itself, or it could be a legislative regulation. Revenue rulings. These have less authoritative weight, but they give more detailed interpretation of the code. So now they're applying to a specific factual situation and giving you an answer. Regulations will interpret, explain, but revenue rulings really get down into the guts and give you real examples, different situations and scenarios. Not as authoritative as the law, but can be used. Revenue procedures. They explain in great detail the IRS practice and procedures in administering the tax law. And then letter rulings. These probably have one of the, they're less authoritative, but more specific than revenue rulings and regulations because it is answering a specific taxpayer's question. Okay, so kind of went through all of that quickly. You should be familiar with all of them. So remember, Internal Revenue Code. You find your answer there, you're done. But then you have tax courts, and then you have the Department of Treasury's regulations, revenue rulings, revenue procedures, regulations, I think I got them all. Okay, keep those in mind. And as you're doing research, that's what you're holding on to get your evidence. When you do tax research, and whenever you take a position on a tax return, that's more complex especially, you need to do this tax research to substantiate what you did. The first thing you must do is understand the facts of the scenario. Then you must identify what issues are involved. Next, okay, now I've got to find tax law, tax courts, or something from the U.S. Department of Treasury that will support and help me to answer any kind of questions I have. Once you have that, now you can analyze all of these items and document and communicate your results. What did you find out? So if you understand the facts, you have to understand everything. You can't just assume something. So you need to talk to that taxpayer. You need to get information. Then you have to identify, what do I have to answer here? What kind of issues are involved? What are the tax issues? What could cause this taxpayer problem? I need to start looking for laws and and information to help me answer these tax issues. And once you start analyzing, that's when you're going to find those answers, and then maybe have to go and find more answers. And then you document and communicate the result. So in your book, I forget the page number, but there is a tax research document there, and you should take a look at it. Take a read through it. Become familiar with it. Two types of tax services used in tax research is annotated and topical. Research questions often consist of questions of fact or questions of law. So the answer to a question of fact hinges upon the facts and circumstances of the taxpayer's transaction, where the answer to a question of law hinges upon the interpretation of the law, such as interpreting a particular phrase in a code section. So you're answering both of these kind, because a taxpayer might say, do I have to include unemployment income in my tax return? Which the answer is yes, but let's say you're sitting there going, I'm not sure. And then you go, okay, I need to answer a question of fact. When the researcher identifies that different authorities have conflicting views, she should evaluate the hierarchy, jurisdiction, and age of the authorities. So let's say you have tax law from 1936 that says unemployment is not taxable, but you have tax law from 2017 that says unemployment is taxable. Well, two different tax laws, both tax laws, so they're at the same hierarchy, but the age of them, you're going to use the 2017. Same with tax courts, same with regulations, same with revenue rulings. Once the tax researcher has identified relevant authorities, so you want to use the newest stuff, she must make sure that the authorities are still valid and up to date. So you create your tax memo by issuing your facts first, your issues, the authorities you're relying on, so you just cite them, the conclusion you came up with from those authorities, and then detailed analysis of how you used those authorities to come up with your conclusion. And I know that one is definitely in your book. So you want to find that in your chapter 2, read the tax memo. You will also create a client letter. You will let the client know about this tax research and what happened with it. So you'll give salutation and social graces. You'll present the research question and any limitations that were involved with it. You're then going to present your facts, the analysis you conducted, and a closing, so they understand. And this is an official document, really, you give to your client. This protects you. Your tax research memo protects you from future litigation, either with the IRS or with your client. You want to look at the client letter that is in your chapter. Read through that. Okay, so tax professionals are subject to various laws, rules, and codes of conduct. The AICPA has a code of professional conduct. The AICPA has statements on standards for tax services. So if you're a CPA, you must follow these guidelines, or you could be sanctioned or lose your license. The IRS's Circular 230 is the Bible. That's what we really use. Any tax preparer must adhere to the rules in Circular 230. For instance, one rule is that you must give a copy of a tax return to your client, or you could be fined. State Board of Accountancy statutes also are out there to let us know what our responsibilities are as tax preparers. Failure to comply with these can result in being admonished, suspended, or barred from practicing. And I have seen people be barred from fraud, Internal Revenue Service fraud, and it's sad. You need to follow the rules. What kind of penalties are there for the taxpayer and the tax practitioner? The most common type of penalties, they're in monetary terms. You're usually not going to jail. But they're imposed when the tax practitioners or taxpayers violate tax statutes without reasonable cause. They did it on purpose. Criminal penalties, much less common than civil, but are out there. So it depends on to what degree you broke the law. A taxpayer and tax practitioner will not be subject to an underpayment penalty if there is substantial authority that supports the tax return position. So you did your homework, you have your substantial authority, primary authority to back up why you took a tax position on a tax return. And you may have a reasonable basis for the position you have tax. So to wrap up our presentation, this chapter took a real nice look at what kind of requirements there are for different types of taxpayers as far as filing their tax return, the statute of limitations on filing the tax return, and the due dates, and gave a comprehensive examination of the different types of tax authorities out there, what is acceptable in a court of law, what the courts of law are for taxes, who creates tax law, and how to conduct research. So now that we are done with that more administrative side of taxes, in Chapter 4 we'll be moving into starting our tax return. If you have any questions, please post them.